Okay, so welcome to another Wednesday night with Brent and Lee, and lots of news tonight going on from the Federal Reserve. We're going to talk about rates, where they are, where they're going. We're going to show you some forecasts, which hasn't really mattered in the past. But we'll show them to you, and then we're going to talk about how you can get across that bridge on the financing, different programs that Brent is going to talk to you about, different ways of approaching the market right now if you need to buy, right? So there's people out there right now that, hey, we don't really need to buy. Maybe you're not buying, you're not looking right now, but if you're looking to buy or you're thinking about buying, there are ways to do that. Because after today's Fed meeting, it looks like we're going to be in this for a while. So we're going to be looking at, rates sitting probably around, between 6 and 8, right, Brent? For a while, I would say.
For a bit, yeah. I believe that's a great assessment. I think from from the Fed statement today and then the press conference afterward, they seem to be pretty determined that they're going to go as long as it takes to bring it down to the 2% range, or at least well on its way to the inflation at 2%, which is currently a little over 5.
Right.
The PCE, the PCE.
Yeah, total inflation's over 8.
Yeah, right.
Yeah. So we're going to talk about that and give you kind of our opinion on the market, tell you what's going on in it, boots on the ground again. Because, you can read the stats and the statistics and all the news, but when you're out there and you're beating the pavement and showing property and selling property, there's no better guide than that. So let's get started, Brent. So what's happening in the mortgage industry right now? What kind of programs are out there, and what are you looking at?
Yeah, there are a couple of ways to find yourself in a better situation from a financing standpoint. Right now, we've talked about the 2-1 buy down, where with seller concessions, right now sellers are making those concessions as opposed to reducing their price, right? And so that seller concession.
Well, we're actually seeing both now.
Yeah, right. We're seeing both, right? That's good. A good point. And what we can do is we can take the seller concession portion and use that credit to buy down the rate in the first and second year. So let's say a market rate for something is 6.75. The first year would be 4.75 fixed, and then the second year it would be 5.75, and then it would go to the 6.75 for the remaining 28 years. So that helps people get into the home, get an affordable rate. And I believe it's a great strategy, certainly if you're anticipating increases in your wages, or you're looking at a situation where, as I believe, within the next 24 months, there's going to be an opportunity to refinance at a lower market rate.
Right. What's that mean for like VA and FHA? Because right now we can do FHA and VA all day long.
Yeah, FHA, VA right now. Before, a year ago, it was hard to get an FHA offer approved.
Right.
VA offer approved from the seller. In other words, not the loan. The loan would be approved, but you couldn't get a seller to take those because they wanted a larger down payment. Even though the money spends the same, they get the same amount at closing. They just feel those loans aren't as qualified, which is really not the case, but that's the impression a lot of people have. And so those offers won't be accepted. And now we're seeing those offers accepted. The rates are lower on FHA and VA as well. We just locked a 4-family at 6.375, and it's a 4-family. So that was so we're really getting competitive on those rates, or FHA and VA. So that's another option for the first time home buyers. The rates are better, but they run about a half point lower on average as a conventional loan. However, you do have, of course, mortgage insurance, but you're putting less down, less money at risk, if you will, too. That mortgage insurance shifts that risk to the lender. So it's a great strategy to get in at a low rate, though, if that's what you're looking to do, and not using a lot of your capital, a lot of your money for a down payment. That's a great way to get into a first home, too.
What about like investors and retirees?
Oh, yeah. Well, investors right now, this DSCR loan is working really well for folks. You know, to buy a property that cash flows, as long as the property cash flows, you can put 20% down on properties that were almost, impossible to finance 10, 12 years ago here in Florida. Condominiums that needed, special approvals. You had to get the condo association approved. We can waive all that as an investor on DSCR loans, as long as the rent payment, we do a rent survey with it, as long as the rent covers the principal, interest, taxes, and insurance, it covers the whole payment. You can put 20% down on that home or condo, and that's an approval without a tax return. So basically, the property stands on its own. It has to be for an investment property, but that's a great way. The investors right now, they're looking for bargains. They're looking to pick up property at lower prices, and we've seen making those lowball offers and getting them approved, and purchasing homes that way without a tax return. The investors are using that.
So we are seeing rental prices come down a little bit.
Yeah, I was going to ask you tonight about that. I heard that reported. Are you seeing that in Florida though?
Yeah,
What are you
no,
seeing?
it's happening in Port St. Lucie. Yeah, it's happening.
Port St. Lucie.
Yeah, we're seeing the rental prices coming down. Yeah, long-term rentals coming down a little bit. A couple $100.
Okay.
So yeah, somebody might, if they're investing, they might have to put down a little bit more money. But the thing is that they're going to be able to buy the properties at a better price right now.
Right. Well, just today, the Fannie Mae and Freddie Mac for first-time home buyers, there's some changes they're making as well. They're lowering they're called LLPAs, loan level price adjustments is what it stands for. And basically, the long story short is, it's going to be less expensive for first-time home buyers if you haven't owned a home for 3 years. So it could be a first home, but you could have owned a home outside of 3 years ago and still qualify for this loan. Those adjustments are going to be removed. And so what they're doing, the Fannie and Freddie, what they're doing is they're trying to make home ownership more affordable for first-time home buyers. If it's someone that's not been in the home ownership game for over 3 years. And however, the cash out loans, the way they're going to make up for that, any cash out where someone's refinancing a home and pulling cash out of the property to pay off other debt, that type of thing, they're going to increase those. So it's a trade-off. So obviously the intention is to help home ownership and to make investing a little more difficult, for a conventional, Fannie Freddie loan. That's what makes those DSCR loans a little more attractive, because the rates are higher on that, but without the LLPAs and, that you're going to see on those, and it might make it more sense to not show a tax return, keep it simple, put a little less down, and buy a cash flow property.
Right. And then you were talking about older folks, retirees, they could, they can put down maybe 50% and then do a reverse mortgage.
That's right. It's called a reverse purchase. And, there's a lot of misconceptions and myths around the reverse mortgage. But basically, it's a home equity conversion mortgage is what it basically is. But what I'm seeing is right now is, people are coming down and they're paying cash and kind of reluctantly doing it because it depletes their cash reserves. Right. And so let's see, they see a $700,000 dream home down here. They're selling their home up in New York for $1 million, or they're going to walk with $1 million. They put $700,000 down. They got $300,000 left, and it's kind of like, okay, how are we going to get that to carry us over the next 25, 30 years possibly in retirement, plus Social Security? That time it gets kind of lean. And so what we're seeing is an opportunity where people, it might make a lot of sense for them if they're over 62, they could say put 50% down on the property, and then since we, just mentioned there, $350,000 as opposed to $700,000, and that would give them $650,000 in that, to cover the next 30 years, and they would not have a mortgage payment. They would just have the taxes and insurance. So basically the balance on it would go up every year as opposed to down, but you can, preserve your cash for retirement and also not have a mortgage payment at all. as opposed to, you know what I mean? So I think that, it still accomplishes the same thing, but you're using that, what would be sitting equity just idle in the property, and as opposed to sitting idle, it helps fund your retirement. So that's a great strategy we're seeing.
So, do you think we're going to start seeing more programs come out, ARMs, things like that, to help get through this time? I mean, banks and lenders know eventually, we're going to get through this. It's not going to last forever. I mean, Jay Powell said that today. We're going to get through this.
Yeah.
It's just going to take some time, right?
Yeah, he was suggesting it's going to take longer than most people probably expect to get inflation to the level they want to see it at, and he sees that as a bigger threat than the threat of a recession,
right?
And so and harder to get out of once inflation's kind of sunk in and expected, and so I think it is going to there is going to be an opportunity. It is going to turn around at some point in time. And to your point, Lee, adjustable loans will come back into vogue. Those rates will come in and they'll be lower. I'd say probably 4 to 6 months from now, we'll see some really competitive. I know some companies are starting to release them now, but they're really not as competitive as a 30-year fix as far as a risk reward analysis, right? But I think it always happens, right? Lenders want to lend money, right? They don't make money until they get interest collected. They'll find a way, offering programs or incentives or strategies to get the money lent out there and to help people either finance retirement or help them get into their first home.
Right. Well, we'll go through the market next week. I've got some market numbers that have come out, but I can tell you that. Let's go through a few slides here and then, kind of circle back to this. So let's look at some forecasts of what, and then, I mean, this changes daily. So, I mean, but it'll just give everyone an idea of what we're looking at here. So, this is, a home price forecast for 2023. And you can see how, different experts expect a different market, right? So, Zellman's the worst with the 5% decrease in prices next year, right? And then we move into Goldman Sachs, Wells Fargo, Moody's, which I have that article right here with us tonight, and then Morgan Stanley. So looking at 5 to 10% appreciation next year. So then Wells Fargo, these are national numbers, right? So these are market specific. The different markets are different. So I was on the phone tonight, right? So with a agent from Georgia, and they've got no inventory on the market. So they have buyers literally waiting for a house to hit the market to suit them. So we're seeing all these forecasts for 2023, 2024 recovery. And then you have this. There are now 2010 housing market risk of 15 to 20% home price declines. This is Moody, right? So they're saying expected home prices at least decline 5% from their peak. Could go 10%. And if we're in a recession, we could see a 15 to 20% decrease. And then moving on from that. But here's the problem. The average home value increased from 2019 to 2022, 36% for condos and 47% increase for houses. And this is nationwide. So right now, I mean, even if you take 20% out of the market, people are still sitting on equity.
Right.
So you're not going to see foreclosures.
No.
If somebody loses their job and they can't make their mortgage, they're going to be able to sell their home.
Mm-hmm.
So that's one thing that I believe is important for everyone to understand. We're not looking at a market crash here because there's too much equity in everyone's homes. This is 85%. And then 85% of the market has a mortgage under 3.5%. This is right from Redfin. So this was So, and that's contributing to a 20% slump in new listings. And this is something that we're seeing happening here in Florida. I was actually in a contract, putting a contract together a week ago, and they pulled the house off the market before they just needed one initial. So ended up pulling the house off the market because they didn't want to sell it for what we were offering after they thought about it for 24 hours. So you're seeing more and more of that of homeowners pulling their homes off the market, and then if they can, they'll rent them. So the only thing we're seeing right now is forced sales, meaning someone passed away, or they're going into a retirement, or they're moving because of a job. These are forced sales happening.
Right.
There's no one saying right now, hey, well, I guess we've got a couple of clients like this, but most people are not saying, hey, I want to move to a different area. It's a forced sale right now. So they're not just putting their houses on the market willy-nilly like they were before.
Right.
And then
doing everything to keep it in some of those instances too, like divorce situations and things like that. It's like, boy, if one of them can possibly swing it, they're trying to. So,
right. Yeah. So with that information, I think we're in a different situation than we've ever seen in our lifetime, because we have we have a job market that's super strong. We have tons of jobs out there. I mean, Jay Powell said it today. There's lots of jobs still on the market that he would like to get those out first. So any jobs that are available, those jobs would go first, and he thinks that could help inflation. I don't know, but we've never seen where we have jobs. Everybody's got a job that wants one, and if you don't have a job, you can go get one. And then there's people are still holding cash because they're still spending it. So we're seeing people spending money at restaurants and retail and travel. So they're still spending money, but then we're looking at fuel prices, heating oil prices, natural gas prices, food prices at record highs. So, I just don't think anybody can predict what's going to happen. We'll see what happens with the election and how things move forward into next year. But with homes leaving the market, and it's just keeping the market tight. I mean, builders are still selling their homes, not at the rate they were before, but they're selling. And so if they keep the prices down, or they keep the incentives high, they're going to keep selling homes because they're going to offset all this closing cost. And then they're starting to come out with different mortgage loans and different ideas so that they can sell homes. So
everyone's getting creative.
I think the market is going to remain very tight. So, we're not here to tell anyone that they should buy right now or wait. I mean, I think that's a personal decision. But if mortgage price, if one of the other is going to happen, right? So mortgages stay high, prices will stay down, right? And you'll see more incentives and more opportunities for credits and so forth, right? Getting seller credits for buy downs and closing costs and things like that. But if rates go down, then prices are going to start moving again, and real estate's going to start moving. And
absolutely.
And I was on a call Zoom tonight with a bunch of agents, and one of them made a really great analogy she heard. She said, it's like an ant pile. Buyers right now. There's so many buyers sitting on the sidelines because the rates being so high that if it's like stepping on the ant pile, right? If you step on the ant pile, the ants all come out, right? So I think that's what you're going to see if rates come back down 5s, right? We're going to see the market fuel.
Right.
And the more programs that come out.
The demand is still there, Lee.
The demand is still there.
Yeah. It's still there. People still want to purchase homes. There are 12 million households will be formed this year with just millennials.
Right.
So the demand is still there. People want to buy homes, start families, right? And so it's just a matter of affordability, I think. You know,
Right. And most people buy payment, so it's kind of like
right,
a car, right? People buy payment. So if they
yep,
can make the payment fit for their budget, so if rates are high, but then get the price of the house down, then they'll buy it, right?
right,
So it's
right,
gonna work one way or the other. So it's rates are gonna go up, prices are gonna come down, prices are gonna go up, rates are gonna come down. It's gonna work one way or the other. So in my opinion, right now, if and we've been saying this for 2 years now, and I can go back into my YouTube site and see all of the comments where people say, "Oh, I'm going to wait till the market crashes." Well, it still hasn't crashed, and
right.
and and now it's literally tightening up where it should be loosening up, but
Yeah,
it's not, because people are in such great position as far as equity. You were going to have to tear out 50% of the equity out of the home to get
yeah,
prices down to where they were, where you could get it 6 months ago, where you could have gotten a mortgage and buy it.
yeah, yeah. A friend of mine, he'll remain nameless right now, but in 2012, he was telling me, I'm waiting for prices to go down. There's no way I'm spending $275,000 for a home in Jupiter.
Right.
You know,
You know,
you
and
know,
granted, I think things got out of control, and look, sellers are going to try to get as much as they can out of their homes, and I do think there are markets that are going to see more decrease in prices than others, but it's kind of one of those things. We're gonna, if you're buying a home to live in it, then if you're going to be in that house for 5 years, I would believe that you're going to be okay, even if we see
mhm,
prices dip and you get into a home and then you lose some equity in that home over the next year. As soon as things start to work there's a way out, and rates start to come back down, then the equity is going to come back in the home, right? It's a long-term purchase,
yeah,
um, as far as real estate goes. If you're
right.
trying to buy a home and flip it in the market, you're going to need to be very, very careful,
You have to buy
because
right. That's
you got to buy
exactly right. I
super
would,
right.
yeah. If someone thinks they're going to buy a house and see another, 47% that we saw in the last 2.5, 3 years, I'd say that's not going to happen. It's just no way. I think that,
It's not healthy for the market. The market got way overheated,
right.
but we do have the situation of all of the, as far as Florida goes, we do have the situation of all of the jobs that have come into this state over the last couple of years and continue to come into it.
Yep.
And I think we're going to see that continuation of migration into the state. And that's going to mean, people need to buy homes.
Yeah. Yeah. I mean, the ADP report came out this morning and it came in stronger than expected. And that's a kind of a precursor of what we might be able to expect on Friday in the jobs report. And I know the Fed doesn't want to see jobs, but the jobs are there. You know what I mean? And so jobs, big picture, you want jobs. Jobs fuels the market, fuels the real estate market, right? It's
Right.
inflation that's throwing a kink in the works here. And so you want to see a strong job market always, right? It's always a good thing for the economy. But right now, with inflation, they just got to correct that. And my personal belief is, I mean, there's things that we could probably do. They're outside of there's things we could do about the fuel situation. That's some things I think hopefully will get corrected. But there's not a lot the Fed can do about energy. Just
Right. No.
it's just supply and demand. So hopefully we can get the supply issue taken care of there, and one of several ways, and that starts to correct that, because that affects everything, right?
Right.
Everything uses oil to transport it, to make it. Oil is a big part of our economy.
Right. Right. So, so, I think that for folks that are looking to try to buy right now, if you have cash, I think investment real estate's a big buy right now. I also, on the other side of that, if you're renting a home, you might want to go to your landlord and see if they'll do a hold the paper for you. Give them some cash down and have them hold the paper for you until the note on that house, until rates come down, and then you can refinance. Right. That's a way to do things. I think we're going to see more of that, actually.
Yeah.
Where someone doesn't want to pay that, they don't really want to sell they're maybe they're renting, but they don't really want to deal with it anymore. And if they sell the home, then they're going to have to pay the capital gains on it. So by, creating an income stream.
Yeah. People get creative. I mean, people were still buying and selling homes in the late 70s when rates were, 16, 17%.
Right. And and look, down times like this too, are people start thinking outside of the box.
Yeah.
Like this, hey, go, like first time buyer situations, buy a duplex.
Right.
Right. You live in it a year, and then you can go get out of it and get something else. Right.
And the payment's the payments go, it's like you say, Lee, they buy payment. And if it makes sense long term, we just locked a deal. It's a 4-family on a VA loan. Amazing deal. I mean, the rent's going to pay his costs completely.
Right. And he has to stay in it for a year.
Yeah.
And then after a year, he comes out of it and he can buy another one.
Right. He could refi it on a conventional rate and term. It has some equity in it. You know what I mean? And he can go out and, just as long as it cash flows, and it will, then he can, go out and use his VA again too once it's paid off. If he wants to do that, or buy more rental property. You know what I mean?
Right. So they're I think for folks out here, like right now, it's like, maybe start that side hustle you were thinking about doing, start looking at the market and saying, hey, where do I want to live? Because I mean, right now you really have an opportunity to go offer, depending on what you're looking for, right? And where you want to be. If you're open to be in, different areas, then you're going to have a lot more opportunity. If you're looking for specifics, then it's going to lessen your opportunity. But
yes,
I think, and also, look, you might not find the perfect home right now. Stay in it for 2 or 3 years, wait till the market recovers here and rates come back down. And then homes are going to hit the market. People are going to start selling their homes again. New construction is really growing around Palm Beach County and St. Lucie County, also Martin County. So there's a lot of opportunities there for new construction coming up 2023, 2024. So, you're not stuck. Just get into a home. I think now's if you're thinking about buying, if you save money, maybe you buy less house, and then you get to refinance that less house eventually.
Yes.
Right. So when you then you're in a better financial position.
I always tell people, if they could just own one rental property, and if you're not a manager or rental manager, rental property manager, but hire someone else to do it for you. If you just had one rental property, hold it for 30 years and pay it off. And if you do the math on that and just put a real conservative, 2 or 3%, appreciation and inflation on the rent increases, what that looks like financially 30 years from now with a fully paid off rental, it'll blow your mind.
Right.
It'll blow your mind. It's life changing,
Right. Well, I think if folks can wrap their head around what I'm saying one more time, that rates are high and they could go higher, but there are different programs coming out and right now, and there's going to be more coming out, like you said, over the next few months. Right. And if you can wrap your head around that, hey, even though that there's not as much inventory as we would think there would be, right now, because of the way people are sitting on such low rates, but there are homes available and you're going to be able to get that home for a lesser price and a better deal. And you're going to be able to use your VA or your FHA, and you're not going to be in a bidding war. You're not going to get into that situation right now. So it's going to be a more comfortable purchase. You can take your time. You can find what your, something that fits your needs and a price that fits your budget and get into the home, because eventually we're going to get out of this. And when we get out of this, then you're going to have bidding wars again. And I can tell you, because we were having bidding wars before COVID, right?
Mm-hmm.
I mean, if you were trying to buy in Port St. Lucie, if you're trying to buy in Jupiter or Gardens or Wellington, and you were on a house that was really, really nice and fixed up and nobody had to do anything to it, you were looking at 2 or 3, 4 offers on that house within a few weeks. And this was 2018, 2019. So, COVID has exasperated the situation, right? And then the migration of people to Florida made it worse. But the problem is that's now not going to stop.
No, people are still moving here.
Right, because of the jobs. The companies are going to keep hiring and keep growing that are here, and they're going to keep hiring people. So that ant pile, I think, is a great analogy. I think it's a great analogy.
Yeah. Well, I think, generally, rents are going to continue to go up generally, over the next several years as that happens, just not enough rooftops, right? And too many people,
right.
And it's a basic supply and demand. And so, we're still seeing, I don't know, Lee, what do you think as far as the number of people you're working with right now? What percentage are coming from other places right now? I mean, as far as they're coming from up north, they're coming from Miami. What percentage?
80%.
Yeah. What percent?
80%.
80%.
Yeah. So,
it's not changing.
No, it's not changing. No. So it's going to keep moving that way, and people are going to keep moving here. Obviously, things are going to slow down over the holidays, right?
Mm-hmm.
Because people aren't going to move over, Thanksgiving and Christmas. So things will slow down. Then after the first of the year, we'll start seeing the market pick back up. And we'll see where we are in January, February. But I think the two, if you can, qualify for a program that gives you a lower rate, like you said, for a couple of years, and then the rate goes up. But, we should see the market start to lean, come back to some normality as far as rates go in that couple of years.
Oh, the next 2 years, almost certainly. I don't see us, he Jerome Powell basically said it today too. He doesn't see, the chance of a real soft landing on this. As far as going into recession, it's that road is narrowed is the phrase he used, So
what's Jenny Start say here?
If you can swing it with today's rate, buy and then refi later, get the mortgage rents market rents will just get higher here in Florida.
Right. Yeah.
I mean, if you can buy at today's rate, just and hold it, it's long term. I think we need to think about real estate too. You're not buying stock where you've seen, 25% adjustment in most stocks, right?
Right.
Real estate, that can happen anytime, and it's a short-term investment, stocks, bonds, that type of thing. But as real estate, it's much more stable as far as long-term, and you really have to look at it that way. It's a long-term investment, and when you run the numbers on it, run any purchase out 20 years, and you're way ahead of the game in real estate for sure.
Yeah, I mean, go check out Ed Milet's show today, Tuesday.
I heard it.
Yeah, with Candy. I mean, girls started buying real estate when she's 19 years old. Check out Graham Stephan on YouTube. Again, kids started buying real estate when he was 18 years old. So, I mean, these people have built, wealth that way.
Oh, absolutely. And, the worst mistake in real estate, 20 years will definitely fix it. Most often it'll get fixed in 10,
it's a long run, it's no different than a stock or anything like that. You play the market for the long run, you're going to win. You play the housing, you play real estate for the long run, you're going to win.
Right.
So, well, I mean, if nobody has any questions tonight, I'm going to cut it short tonight.
Oh, that's
Brent,
good.
you got anything to add?
No, I think it covered a lot of different things. I think, I just want to encourage people. I think, a lot of times people get fearful about, some of the comments today. Um, the, the 0.75 hike and then talk of what the next hike is going to be. That's already baked into interest rates, so interest rates will be, already baked in the mortgage market. Now, if you're holding, credit cards, that type of thing, anything tied to the prime rate will go up with that hike as well. But then after that, they're talking about, some sort of pause or certainly a reduction in the pace that the rate hikes. So,
Yeah.
stay strong, hang in there. We're going to get through this,
Yeah. And check out Brent's YouTube site. It's United Lending. Brent Starts. He's got a great thing going there. He's got some great information, and he'll keep you up on mortgages and what's happening. And then we'll see him every Wednesday here with me. And don't forget, if you haven't subscribed to our channel, subscribe both channels, and don't forget to ring that notification bell so you don't miss any of our real estate tips and tours. And also give us a like if you like us, and share the video with people so that they know that we're here every Wednesday and we can answer questions, and it helps us grow the channel and help other people, and we really appreciate it. So we're going to cut it short tonight, but be kind to each other, and we'll see you next week.